Hello and welcome to the Currency Exchange, NatWest Markets FX podcast, where we break down the major themes and events driving markets this week and for the week ahead. Today I'm joined by Giovanni, who is our European head of economics. And what a week for Europe it was. On Tuesday, we had the announcement of European Commission President von der Leyen that she could mobilise up to 800 billion for European defence spending, and shortly followed up by Germany, who also plans to ease the constitutional debt brake to increase defence spending. What was your take, and I guess what did you think was the biggest announcement?
Okay, so as a European economist, I've been waiting for this announcement from Germany for, I think, more than 15 years.
You've been patient.
So I think the most important announcement is the one coming from Germany, definitely. It was also, in a sense, even bigger than the European one, not just because, of course, Germany is smaller, but actually in the numbers, they gave this incredible envelope that was 500 billion for infrastructure, and then something that was, valued at 400 billion potentially for defense, but actually is a limitless amount. Everything that is 1% above will be considered as outside the debt breaks, will not count as something that will be limited by the fiscal rules. So it's potentially very big. Of course, it's an envelope. It's not real money. We don't know yet when it's going to be spent, how it's going to be spent, but it's really, I think, a big game changer in terms of the direction that we're taking. That's really new for Germany, and I think it's very positive for Europe.
And I guess kind of outside Germany, we've also had the European announcement. What do you make of that? How big is it in actual effect, and what does it mean for the countries outside of Germany?
Okay, so the announcement there was, 150 billion of a potential EU fund for defense, and then the capacity to use the exception clause within the Stability and Growth Pact to be able just to spend more on defense for a number of years, and that was the other 650 billion. So I think that is also an important piece of the puzzle. I think that Germany is the biggest one. They have the biggest fiscal space, so it makes sense for Germany to be asymmetric in the spending for defense and for other things, infrastructures. But I think it's an important complement. I think there will be more. There will be more announcements. There could be other ways to increase the expenditure and the fiscal space for defense expenditure if needed. And I think it's a concerted, in a sense, announcement which adds this European dimension, which is very important. I'm not saying that Germany is spending only for Germany and that defense expenditure is a public good. It's a European good anyway. It's not because it's Germany that the others will not benefit from it. But of course, the European dimension gives also this kind of message of unity, and I think it's very important. We still, again, don't have the details. So tonight we might have some more from this meeting that is taking place right now. And I guess that we'll have to wait even more for a more concrete plan. So. But again, everything is moving in a direction to give the flexibility and the potential for Europe to respond to what's happening in terms of defense and in terms of the NATO and the US approach.
I know, yes, at the moment the EU proposal is just that. It is a proposal. We are obviously waiting for the announcement from the EU summit being held today on Thursday. Is there any way to gauge at this moment, sorry to put you under pressure, the effective size or the effective timing over which this fiscal boost could come?
So again, it's a bit early, and I would say if you look at the normal timing of all this, you have the parliamentary processes, you have the discussion that have to take place, the selection of the plans, the decision at the national level. So I think it's reasonable to say that it's not something that will happen not before the second part of the year, and probably in 2026. So that is, for me, the kind of framework. And the amounts that are mentioned, of course, there are, these are stocks, these are amounts that you have then to compare to the flows of GDP. So, of course, it's, for example, for Germany, we're talking 20% of GDP, but it means, let's say, I don't know, less than 2% over a number of years, if all the envelope was utilized. And for Europe, it's a little bit the same. We're talking about 800 billion over a number of years, which would be, again, something, in terms of GDP per year, something around 1% or something. So I think that the idea is to say it will be significant. It will be delayed to, say, from next year, but then we have to look at the details. If we take as a rule of thumb 1% increase in expenditure, it should boost GDP by roughly the same amount next year, and less the following years, and it will also imply some increase in the deficit. Again, less than the 1%, because there will be some positive impact from the boost to growth in terms of fiscal revenues.
Yeah, really interesting that we don't have all the details yet. And yes, it's such a massive impact on financial markets, both in the FX space and also in bonds. I guess when the expectations were just so low that Europe would come through with something. But there was something else driving financial markets, though to a lesser extent this week. It is actually ECB day. What did you make of the European Central Bank's decision?
Yeah, so it's true that the ECB was a little bit a sideshow today, given what's happening. No, I think that they just did as expected. So we had the 25 basis cut as expected. We had this kind of tweak in the language as expected, but still maintaining the idea that we are not a neutral, so we're still restrictive. Although we are close to neutral, but we're still restrictive. So suggesting that there is potential for more rate cuts. And in my view, there will be more rate cuts. I had 2 more in April and in June, and there's nothing in today's announcements and decisions and expression of views from Lagarde that change that. Because if you think about it, this idea of we are getting close to 2% in terms of inflation, we are more or less close to neutral to rates, it is in the context of assumptions for the projections that were based on the numbers that we had 3 weeks ago.
Okay, so it doesn't yet incorporate potential fiscal spending.
Potential fiscal spending, but that's for the future.
Yeah.
But in the short term, you had, as you said, financial markets have reacted quite significantly. So we have a stronger euro. We have lower oil prices, lower gas prices, much lower gas prices, and we have also have higher long-term rates. So this is a mix that basically argues for tighter financial conditions and for energy prices for lower inflation. So basically, if you had to take the data, the ECB is data dependent, no? So if you had to take the data today, you would probably have a lower number for inflation, a significantly lower number for inflation. So I think that the reasons are there for another cut in April, also because we will have probably tariffs from Trump at the beginning of April, and because we will not have enough information, most probably, on all this fiscal package. So I think that it's definitely the case that April is in play for another rate cut, and I would say June as well. I think it's still too early to have a massive driver of higher rates embedded in the forecast of the ECB in June. So of course you remove the tail risk of much lower rates, expansionary policy, monetary policy, but I don't think that it negates the idea that we will move towards to 2% in June. I still think it's a credible central scenario.
Which is definitely the opposite of what the market has done, right? They've just thought fiscal easing, reduced ECB rate cuts. So really interesting that actually when you take the data at face value, as you say, they are data dependent. It really argues for continued easing.
Yeah, so and absolutely, and the difficulty will be to kind of disentangle the short-term dynamics, and by short-term I mean the next 3-6 months, which are still leading towards lower rates, and then the potential for a different story for the medium to long term, and that will be, I think, the market battle of the next several months.
Okay, I'm going to ask you a very big question now. But you think the latest developments we've had, both in the US and Europe, in terms of increased defense spending, do you think it could jeopardize the dollar as a reserve currency and potentially see kind of the proliferation of European assets as a store of value?
Yeah, I think that's a very profound question.
Thank you. Yes.
No, and I thought about it, and I started to look at some of the numbers, some of the related questions, and I think that's a potential consequence of what we're seeing, which is related to the the strategy, in a sense, the trade war, tariff strategy from the US, and the defense chapter related to that in terms of providing the NATO umbrella for European nations. So if you remove that, in a sense, you're also removing the reason to have such an exposure and such a and to give such an importance to the dollar. The exorbitant privilege of the dollar is a little bit put into question by this attitude, and I think that this is starting to be part of the discussion. Also, because if you look at the trade relation between Europe and the US, I mean, we don't have time to go into much details here, but the bilateral current account is roughly balanced, whereas we have a very significant ownership of US assets. So we are basically recycling our current account surplus with the rest of the world into US securities. And so that there is an element of that is related to this kind of Pax Americana related to so it's not just a financial sector, but also a defense element of the story. And so if you remove one of these, if you are less sure that this support is there from the US, then it's not that sure that, I'm not talking about governments, I'm talking about investors in Europe, so certain and so willing to continue to have this exposure, this excess exposure to the US. Plus, you will have a lot of European bonds that will be issued if we have.
And I know very cheap as well.
So, so things can change. Yeah. We have a little bit of that, of a flavor of that right now. But
yeah, really interesting when you think about, I think all the US sanctions we've seen have kind of weaponized US assets. And so we've seen a kind of move towards shifting reserves out of US assets, for example, central banks buying gold. But it's interesting that this could provide another kicker or another source of momentum to that same trade. Gio, really interesting stuff. Thank you so much for joining me. That is all we have time for this week. But if you did like the podcast, please do click like. And remember to subscribe so you get the latest episode first. Thank you.